Well, today what we want to do is start talking about the Federal Reserve and monetary policy. First of all, a little bit of institutional stuff just about the Federal Reserve, and then we'll get to the monetary policy later. We sort of build up to that. Let's first of all talk about the structure of the Fed. The institution itself. Maybe a lot of you know about the Federal Reserve. I like to draw a little triangle here. At the very pinnacle, and this is the Federal Reserve System, I'll say FR System. At the top of this is the Board of Governors. And they're in Washington, D.C. It's a 7-member Board of Governors. I'll put this over here, 7 members. And then of those 7 members, they serve 14-year terms. So that's a long term. And the way this works out, every other year, every second year, one of the board members retires, his term is up, or his or her, and then they're replaced by somebody else. So what you have is this situation where every 2 years you get a new member of the board. If somebody would resign or retire before their term is up, then somebody else will be appointed to take their place just for the rest of that term. So let's say that you had a 14-year term and you worked for 7 years, then somebody else would come in and they would just have the rest of that 7 years. Okay, and so then the turnover rate of the Board of Governors wouldn't be affected that way. That being the case, then what you can see is that since just every other year you get a board member, then in a presidential term there would just be 2 new appointments by a president in one 4-year presidential term. And so the president doesn't, who makes the appointments, the president doesn't get an opportunity to stack the board with his or her, well, I guess it's his so far, we've always had a male president. But anyway, in a 4-year term, the president can't just put a bunch of people on the Board of Governors and say, here, now I get what I want. 2 members. And then in the next 2 years, or the next term, if the president has another term of office, 2 more members. So really, just at the end of his second term of office, has he appointed a majority of the board. And so there's really not much opportunity there for the president to stack this board up and control the Board of Governors that way. In addition to the 7, or not in addition to, but of those 7 members, one is the chairman, and it's always been a man up to now. But the chairman, and as the chairman, this is a member of the Board of Governors with a 14-year term, but the term as chair is a 4-year term. And so let's just say you get appointed to the Board of Governors. Usually what would happen is a president would use a new appointment, say, okay, here's 14 years for you, and I'm going to make you chair. And that's normally how it would work, but it doesn't have to be. In theory, what could happen is the president could come in and say, hey, look, the old chairman's term is expired. I'm going to appoint you the chair, and it'll be for a 4-year term, and it could be for somebody who's already been on the board 4 or 7 or 11 years or whatever. Okay. This person is dominant within the Federal Reserve. I mean dominant. Yes, sir?
And that's chosen by the president?
Chosen by the president, and then the Senate has to, it's sort of like with appointments as members of the cabinet, ambassadors, federal judges, and things like this. The president will choose somebody, but it's with the advice and consent of the Senate. So there's a Senate committee, the Senate Finance Committee, that will look at this, make a recommendation, and then the entire Senate will vote on that. But almost, I think always really, when the president picks somebody, then that person gets the endorsement of the Senate. But the Senate doesn't have to endorse them. So anyway, that's kind of the way that works. There's a story that sometimes gets told. Several years ago, what was it, 1979 through, I think, 87, there was a guy named Volcker, Paul Volcker, who was the chairman of the Federal Reserve. And there was a story that used to get told during his chairmanship of the Federal Reserve. And this story still illustrates what I just told you about how dominant the chairman of the Federal Reserve is. The story goes like this, is that the Federal Reserve Board went out to dinner. They were going to, they had had a long meeting that day, so they all went out to dinner together. And so they're sitting at a big oval table, and sitting at the front of the, at the end of the table is the chairman. And so the server comes up and says, I'd like to take your order. And so the chairman says, well, I'll have a sirloin steak, and the server writes this down and says, and what about the vegetables? And Volcker says, well, we'll just let them order for themselves. And so the whole point of this is, everybody else is a vegetable on that committee. You've got the chairman, and you've got a bunch of other people that kind of go along with the chairman. It doesn't have to be that way. It could be where the chairman would come in and say, here's what I think we ought to do, and everybody else could just say, no, we're not going to do that. But it really hasn't worked out that way. I think the last time there was any significant conflict between the chairman and the rest was in, I'm going to say 1970. There was a guy named Arthur Burns that came to his first meeting. He was appointed chairman. And so he said, here's what I think we ought to do. And then the board kind of says, we don't necessarily see it that way. We've been here, for several years. You're the new guy. And he says, well, I am the new guy, but I was selected by the President of the United States to come in here and run this committee, and you weren't. And all of you were appointed by a different president. And so I think I'm in charge. And so they said, well, maybe not, maybe. And so they had a little discussion, and it went on for a couple of days. These meetings go for 2 days anyway that they have. And when the meeting was all over and the smoke had cleared, then the chairman had basically dominated that position and, had the endorsement or the support of the others on the board. Usually what happens is, this is just generally understood. If you got appointed or I got appointed to the Board of Governors and it's not as the chairman, then we would pretty much know that we're expected to certainly vote our conscience and certainly let our feelings be known, but to recognize that one person has got the endorsement of the president to go in and provide some leadership, and it's our job to provide good counsel, but not necessarily to throw roadblocks up in the way of the chairman. The chairman can dominate these meetings in a variety of ways. One is he can just say, the president wants me to do, the president put me in this job as chairman to guide the Fed. And that is a powerful thing. But then in addition to that, the chairman is the one that for the other board members gives them assignments. Here's what committees I want you to serve on. Like we need to have a study of, the effects of some new check clearing policy, or the effects of some policy with respect to, other central banks, and so forth. And so then you can be put on these assignments. If you're a member of the board, the chairman would decide, which of these committees you go on. So if you're a person who has strong feelings about some issue and it disagrees with the chairman, then the chairman would not assign you to be in charge of that particular research project or whatever, but put you on something else and put somebody else, that maybe is more in agreement with him in charge of that issue. And so the recommendations that come forward from that committee or from that research assignment would be more in liking by the chairman. The chairman does other things, like when they have their meetings, there's an agenda. Here's what we talk about first and second and third and so forth, and the chairman decides what goes on the agenda and when it is discussed. And so if you're somebody that's kind of troublesome, the chairman would put you late in the meeting where everybody's kind of tired and ready to go home and so forth. And if you're somebody that the chairman wants your ideas to be heard and discussed a lot, at great length, put you early on in the meeting. So the chairman has got different ways of making his wishes known. And Paul Volcker was just, one in a long line of people that this story about let the vegetables order for themselves, probably that would apply to just about any chairman we've had throughout the history of the Federal Reserve. We had a guy named Greenspan that came after Volcker. Greenspan, 1988. I guess he took office in the middle of 1987 and stayed in office until, I don't know what year, 2000, does anybody know? Maybe 2006, I'll put a question mark out there. And so he was in office for an awful long time. What do we think about that? How many years is that? Is that within 14 years? No. So what can happen is this, is if you get appointed to serve a partial term, let's say that there's a 14-year term and somebody appoints you to, maybe somebody's in office for 3 years on the board and they leave and you come in, you serve an 11-year term. You can only serve one 14-year term, but you've had 11 and now we can give you another 14-year term of your own. And so you could serve potentially 13 years plus 14, 27 years, right? Now, nobody has ever served that long, but the point is that there are people who serve in that office for a long time. This is Alan Greenspan. And Alan Greenspan, some people like him, some people hate him, but Alan Greenspan has had what I think most people would agree, most economic historians would agree was the most successful chairmanship of the Federal Reserve throughout history. He's been really dominant. Who's the chairman now? Bernanke. His first name is Ben or Benjamin Bernanke. He used to be a professor of economics. He taught a class, something like this one, not as good, before he went to the Federal Reserve, just kidding. And, well, not really, but, you know, I want him to feel good in case he's tuned in. Anyway, but Bernanke has been in office, I think, 2006. I'll have to put a question mark next to that, and probably will have many years in that office. Okay. Bernanke's specialty, back when he was doing research and a university professor and so forth, but economic history, and especially monetary history, but big expert on the Great Depression. And so when we had this banking crisis and economic crisis in 2007, 8, and 9, Bernanke was there at the Fed and did a lot to prevent that from getting out of hand and actually becoming a lot worse than it was. There was a lot of this talk about Great Depression or another Great Depression. Well, Bernanke knew how we got into the first Great Depression and some of the mistakes, the policy errors that were made at the time. And so what he did is avoid all those policy errors. And that doesn't mean he was perfect, because you have to be sort of quick on your feet and respond to sort of emerging crises as they break. But he knew, I think, the big pitfalls and helped us avoid those. So far, I think he's getting high marks from most economists in how he's handling things. Under Greenspan, the United States went from well, it actually started with Volcker, but we had a recession that ended in 1982 in November. Our next recession was in the summer. I'm not exactly sure what months, but like June through September, something like this, of 1990. Okay, the next recession was in, when did that start? I'm going to say in the winter, like in January, February, something like this. But in 2001, this recession was about 6 months long. This one was about 6 months long. And so what we had was this period of, that would be almost 20 years, that we had two recessions in 20 years, and each one was a short recession. So the Federal Reserve during this period, and it started during the Volcker years, but continued mainly through the Greenspan years, the United States has avoided recessions like we had normally had one about every 5 years, or 4 years sometimes, but we avoided most of the recessions that we'd had and had these very long 9 and 10-year periods of economic expansion. And so we've had some really good economic performance, and I think most people would say the Federal Reserve has been the key economic player in the process, helping us avoid that. So anyway, a little bit of history mixed in with the institution. So we've got a board of governors, 7 members. I'll put a 7 up there. The next layer in this pyramid is the regional, and I'll put that in parentheses because that's not part of their official name, but the Federal Reserve banks. And there are 12 regional Federal Reserve banks. Okay, scattered around the United States. I wonder if I can do this. Let's see if we can name them all. Boston, New York, Philadelphia, Richmond, Virginia, Atlanta, Chicago, Cleveland, Minneapolis, St. Louis, Kansas City, Dallas, San Francisco. Let's see how many I left out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Hey, didn't leave any out. Anyway, so we've got these Federal Reserve banks scattered around the United States. They are regional Federal Reserve banks. As you know, we've already talked about this before. Let me just take this off because I don't want anybody thinking that we stole British Columbia from Canada. Anyway, this map was established in 1914. Well, 1913, the law was actually passed, but in 1914, the Federal Reserve opened its doors, and all of those Federal Reserve banks were established at the time, and they haven't ever moved since then. Each bank serves a district, and that district it does not follow state boundaries or anything like that. And that district is sort of an economic area where there was a lot of trade and interaction and so forth at the time the Federal Reserve Act was passed. Okay, this was like the dominant city in the district at the time, and that doesn't mean that it's dominant today or that the same trade patterns are prevalent or anything like that, but this was all set up due to political compromises and so forth back in 1913. The only state with 2 Federal Reserve districts is Missouri, and this was as a result of a political compromise made at the time. It doesn't mean that, somehow Missouri is dominant, for the United States economy or that it was at the time. It was just that they had enough votes to get their way for 2 different Federal Reserve districts. Anyway, the banks within a district do business with that Federal Reserve Bank. This is the operating level. This is the executive. The Board of Governors is the executive level of the Federal Reserve, and they are in Washington, D.C. They do a lot of research, and they make rules and that sort of thing, but the actual operations of doing business with the banks, lending money to the banks, clearing checks and so forth, the operating aspect of the Federal Reserve is done with the district or the regional banks that are scattered around the United States. Each one of those Federal Reserve banks, I think all of them, there may be an exception, but each one of those Federal Reserve banks will have branch offices. And so there's the Kansas City Federal Reserve, and it encompasses a fairly large area, and it has, for example, a branch office in Denver. That's not the Federal Reserve Bank for that district, it's a branch office. And so anyway, that means that the banks in Denver can do business with the Federal Reserve without having to go all the way to Kansas City. Okay? Of course, or maybe it's not of course to you, but the New York Federal Reserve Bank is the largest in terms of the assets, the bank assets in its district. It's the largest in terms of the one doing the most interaction or transactions in the financial markets. And it has always been the dominant Federal Reserve Bank in the system. Okay? In the earliest days of the Federal Reserve, in 1913, and at least for the next 30 years, the New York Federal Reserve Bank was dominant within the system. Like they would have meetings and talk about things and debate things and so forth, but it was always the New York Federal Reserve Bank that dominated that process. And then there were amendments to the original Federal Reserve Act, really 2 key amendments, one in 1933 and then another one in 1935. And what happened as a result of that is control of the Federal Reserve was shifted legislatively from the New York Federal Reserve down to Washington, D.C. What do we have? Washington, D.C., where the headquarters is. But the legislation passed in 33 and 35 shifted control of the Federal Reserve, or the dominant power of the Federal Reserve, to the board. And before that, the board really was not a dominant player in this process. Okay, I think I mentioned before that the board was mainly sort of political appointments, sort of a congratulations to somebody for having an illustrious career, but they were not all that knowledgeable in the earliest 30 years of the Federal Reserve. I guess that would be 20 years of the Federal Reserve's business. Okay, so anyway, before I go on to this last group, let me mention that there's a key committee the Federal Open Market Committee and that is a committee comprised of the 7 members. FOMC is the common abbreviation for this, the acronym. And then that includes the 7 members of the board plus 5 of 12 of the presidents of the Federal Reserve banks. And so that key committee has got 12 voting members. The FOMC does. And that is the group that really sets monetary policy. It's not the board, it's not the regional banks, it's the FOMC. And they will meet about, how many times a year? 8 times a year? 9 times a year? If it were 8 times a year, that would be, about once every 6 to 7 weeks. They will have a meeting in Washington. The 7 members of the board, well, let me say this. All of these 19 people attend the meeting. So all 12 Federal Reserve Bank presidents and all 7 members of the board attend the meeting, but when it's time to cast votes, 7 votes from the Board of Governors and 5 of the presidents vote. So you can see the voting power is theoretically held by the Board of Governors. Now, the thing is, it's easy to stand around here and just kind of talk about the voting power and who's in control and who's in charge and so forth. The reality is this, though. You get 19 people that are attending this meeting. And by the way, they can all talk, they can all make suggestions and so forth. It's just the 12 votes. But you have all these people attending this meeting, and out of the 19, there will probably be 17 of them with PhDs in economics. And they've all studied pretty much the same theoretical models. They've all been studied the same research. They all share pretty common views on things. It's like if you got 19 doctors together and ask them, what should we do about, I don't know, the common cold or an ingrown toenail or whatever it would be, pretty much all those doctors would say the same thing. They share this common background and so forth. And a lot of them probably went to school together and have been at conventions together and so forth. And so it's not like they get to a meeting and there's just a lot of anger and hostility and disagreement. Almost always there's agreement. Generally speaking, though, there's a little bit, I would say, at the Federal Reserve Banks, a little bit more hostility towards the idea of inflation. That's harmful. We can't stand that. A little bit more suspicion, like, gosh, I think I see inflation on the horizon. We got to get busy and fight that. And a little bit less of that attitude in Washington. But that's just a general impression rather than the way it has to be. The St. Louis Federal Reserve Bank has always been sort of an inflation hawk. Here's St. Louis. They're kind of inflation hawks. That is to say, they've got this long history within the Federal Reserve as watching carefully and say there's too much money in the economy, there's too many inflationary forces, it's time to start fighting inflation. And that's kind of their history. And so these Federal Reserve banks, for the people that study it, know a lot about it and so forth, they kind of see sort of a personality of these different Federal Reserve banks. And there's a history there that they will carry on with. And they'll have a staff of people that study these topics. And so the St. Louis Federal Reserve will very often be one of those inflation hawks. And there usually are others that will join them. Okay, so anyway, well, we won't get into that too much. This group, I just cannot overemphasize, the Federal Reserve has 3 policies that are really important, and we're going to come back and talk about those policies later, but 3 policies that they use to control the money supply most of the time, and one of those policies is made by just the board. One of those policies is made by the Federal Reserve banks with the advice and consent of the board, and then the third policy, and the dominant one, is made by the group. And so really all of these 3 policies are discussed within the entire group of 19 that meet, as I say, once every 6 weeks. In addition to those meetings about once every 6 weeks, they also have telephone conferences where there will be about 3 of them get on the phone every single day and talk about, well, what are the markets doing today, and they'll talk about what the markets are doing, the credit markets, what's happening to interest rates and so forth, what's the economy doing today, and what are our goals, what did we talk about the last time we met. And so there's a constant monitoring of these markets, and if something needs to be done on that particular day, some emerging crisis or problem or whatever, they're on top of that. And they can always get other people on the phone, and have like an emergency meeting. And every once in a while, that kind of thing will happen. But there may be from this meeting some kind of a directive, like, here's what we want to do. Over the next 6 weeks, we'd like to see thus and such happen. We want to inject $10 billion worth of reserves into the banking system. And but then they leave it fairly open. And then as they talk about emerging conditions in the markets every day, they may say, boy, today's the day to do thus and such. Let's really put a lot of this credit in the economy today. And other times they might say, let's drain some out, because here's what we see. And so there's a constant keeping the finger on the pulse and keeping monetary policy headed in the right direction. At the bottom of the pyramid is the part that, 2,300 member banks. And these member banks are not government organizations. They are privately owned, for-profit banks, just like the bank down the street or the bank in downtown or whatever. They are commercial banks that join the Federal Reserve System. And you remember that's all 1,600 of those nationally chartered banks and another 700 banks that have state charters that choose to join the system. And these banks, member banks, they have the prestige of being member banks of the Federal Reserve. They have accounts at the Federal Reserve. Where do they keep those accounts? At their regional Federal Reserve Bank, their reserve accounts. Okay? And then basically they are interacting with the Federal Reserve more than the other 4,700 banks in the United States, but they are have an opportunity to select board members at the regional Federal Reserve banks. They are consulted to some extent, but they don't make policy. They're just members of this organization. So anyway, there's our Federal Reserve, kind of how that is set up. This is a fairly unique situation. I talked about this Federal Open Market Committee, and it started off in 1913, continued through all of the legislation we've had. We've had this really unique situation where we've got Washington, D.C. represented, not Washington, D.C., but the political side of our society. The Congress created the Federal Reserve. Well, it was an act of Congress. The Federal Reserve Act was passed in 1913. So there's a board, and they are appointed by the president, and then they had the advice and consent of the Senate. So here we had these 7 members. We've got Federal Reserve banks. They are actually choosing a president of the Federal Reserve Bank, chosen by board members, and some of those board members, I think 6 of 9, are chosen by member banks. And so what you have is a system where we've got this political side and we've got this sort of financial side, the banking side of our economy. Some of these people that are chosen on the boards of the regional banks could be teachers, could be businessmen and women, could be a mayor, it could be just any member of the community. And so some of these people that are on the board are actual bankers. So you really have input from a lot of different places, a lot of different perspectives that go into making monetary policy. And it's pretty unique. Most central banks overseas, other countries, will have this political side where we've got people that are appointed by the government, and then that's the end of the story. And some people see this as undemocratic. They find that objectionable. They want to do something about it. These people, they would say, are too insulated from the political forces that, the elected democratic political forces that we have in the country. Other people say, that's not all bad because the political side can get influenced by, is there an election coming up or something like that? And we'd like to have people that cast votes and have independent viewpoints that are not influenced too much by politics. And so we get into this discussion of the Fed's independence from political influence. Here's the theory. The Federal Reserve was created by Congress. The president signed the bill. Which president? Woodrow Wilson. The president signed the bill. The Congress passed the bill. The Congress can always come back and amend the Federal Reserve Act, change it. They could make any change they want to. So there's not going to be an independence from Congress, the House, and the Senate, and the President. There cannot be independence in some sort of long-term, permanent sense. It's independence sort of on a day-to-day, week-to-week basis, where we basically say we've created this institution and we, the Congress and the President, decided that it is best not to have the Congress and the President meddling too much in monetary policy as we go along. Why not? Why no meddling from the Congress and the President? Well, the easy answer is to go back to China in 900 AD, someplace you probably have in your notes. First paper money. Before China had paper money, there was gold and there was silver and bronze and copper and other things that had served as money throughout the world. And you know, there had been some, but not really much of a problem of inflation and so forth. And the reason there wasn't much of a problem of inflation back with the gold and the silver, and electrum, if you remember, was the term we had for the first coins. The reason there really wasn't that much problem with inflation is nature is very stingy with that gold and silver and so forth. Nature doesn't just say, oh, you want gold? Here it is. Nature says, come looking for it and see if you can find it. And people will look sometimes for a lifetime and not find very much. And then when they do find it, it's usually pretty hard to extract from the earth. Sometimes they dig holes in the ground that are very deep. And, you know, you might spend $500 getting $600 worth of gold. Most of the gold in the world today is found, I don't think I mentioned this before, but most of the gold in the world today is found as just tiny little specks just out here in dirt. And I don't mean to say out here outside the building, but in soil. And so it's a very difficult process to, first of all, I mean, you can walk over that dirt and not realize there's gold there. But if you said, there it is, and you get a handful of dirt and just start going through it, a little speck by speck and trying to find it, that's a very time-consuming process. And then they do have an industrial process. But I'm just saying to you, gold is not an easy thing to find. And so we don't get too much of it. But along come the Chinese, and then if you remember, it was Marco Polo that took the idea back to Europe later on, about 1300 AD. But along come the Chinese and they say, got an idea, let's have paper money. And I'm coming back to this Fed independence idea. And so the Emperor of China says, oh, paper money, good idea. I want to buy stuff. And before that, you know, if he wants to buy stuff, he's got to have gold or silver, these precious metals. But all of a sudden he says, I want something, print the money up. And the printing presses start. And if you can print an infinite number of, now it would be dollars, then you feel like I can buy an infinite amount of stuff. It looks like that, but the longer term effect is prices go up. There's not more stuff to be bought. There's a certain amount of stuff to be bought and an infinite number of dollars trying to buy it. And so the price of each one of those things that we're trying to buy goes up, up, up. And this had been the history, you know, throughout time. You can do a little thought experiment. If you had a copy machine and all you had to do is push a button and you can make $20 bills. And there's that deal there where you can say, how many copies do you want? Would you say 3 or 5? Or would you say, I got 3 digits on this. Let's make it 999. Let's make as many as we can. Boom, go. And if it had 4 digits on it, you'd make it 9999. Make as much as you can. You can always think of stuff to buy, right? Well, this is the history of paper money. And it's not like it happens every single day, every single place. But over time, what happens is this: oh, we've got this power to print money, and then there'll be some need to print money. A need always comes up. It's sort of like you might have a credit card, and you think, oh, I'm going to be careful with this. But you know, the need comes up. And you get that piece of plastic out, and you buy something. And so if you've got a printing press, and you can make all the paper money you want, the need comes up. And it may take a year or 2 or 5 or 10 or 50, but the need will come up. Let's make an infinite amount of paper money. And this is the history of mankind since 900 AD. Anyway, so the people who set the Federal Reserve up, and by the way, this has happened in the United States. It happened during the Revolutionary War. It happened during the Civil War. And so there was this, we had this experience, this knowledge. You remember there was a National Monetary Commission that went out and studied these issues that turned into the Federal Reserve Act. But anyway, they started studying this in 1908. They studied it for several years. They came back with a proposal. And those economists and bankers and congressmen and so forth that served on that commission, they knew about this. And so they said, hey, let's set up a system where there's some independence. The organization has some independence from politics, because if we just let the politicians place an order every day and tell the Federal Reserve what to do, there will be a day when they place the order, turn the printing presses on, and don't turn them off. Put more zeros on each bill. Rather than a $2 bill, make it a $2,000 bill. Put more zeros on there. We want to spend money. And you know, our constituents, this would be the Congress, our constituents don't like to pay taxes, so we'll just get rid of taxes, and we'll pay for everything by just printing up money. And our constituents want more roads and more schools and more everything, free lunches. Let's just print the money. And so democracy wouldn't be immune to these. Maybe democracy is more susceptible than any other system to these kinds of demands. And so the thinking was, in 1913, let's have something that is independent from day-to-day political influence. Now, we don't want to have some sort of dictators at the Federal Reserve that can do anything they want to do and nobody can stop them. But we want to have some people that have some independence, and unless they are reckless and irresponsible, we'll just keep our fingers off of their business, or our hands off their business. And so here's this idea of independence. Independence comes in a couple of different ways. First of all, I told you about the 14-year terms. If you put somebody in office for 14 years and say, we are not going to mess with you unless you do something that's illegal, you've got your job for that 14 years. It's hard to step in and influence that person. If you gave them a 1-year job, what you could say is, you know, we're thinking about reappointing you, but I don't know if I like your point of view. Why don't you tell me again what you're going to do? And then in order to be reappointed, maybe a member of the Federal Reserve Board would say, oh, here's what I plan to do. And say, okay, we're going to give you the job. What if you plan to print more money? Increase the money supply. But a 14-year term, that provides some insulation. And the other thing that provides some insulation is the Fed has its own budget. What I mean is this. Let's consider any other part of the government. Let's talk about the Department of Transportation, or the Department of Defense, or the Department of, you name it. They say something like this: hey, we need to build some highways. And then they'll come forward with these proposals. We need $47 billion for the following projects. And then they will submit this proposal for this $47 billion provided to the president. The president will gather these proposals up from all the other departments. Of course, he's already worked with them, the president has, and so then he comes forward with his budget and he hands it to the Congress. Now, Congress will then go through that and say, well, we don't need that highway, but we do need an off-ramp out here, and and this sort of thing. And they'll go through and they'll kind of mess with that budget. And they may say something like this to the Department of Transportation: we told you to do something last year and you didn't really do it. So here's what we're going to do. We're just going to squeeze you down a little bit on your budget. We're just going to take 5% out of there and make you feel some pain and let you know that we were serious when we told you to do something. And you didn't do it, so we'll take out 5% or 3% or whatever the number is. Or maybe we'll even tell you to take a few people off of your staff. Make everybody work a little harder there in your office. And so the Congress having control of the budget can influence the Department of Transportation, Department of Defense, Department of Education, and you name it. And so if the Congress wanted to influence the Federal Reserve, what they'd say is, if they had control of the budget, hey, we're not going to let you give raises to your staff. Or we see that you've got 2,000 people working down there. Why don't you just lower that to 1,800? Why don't you do what we want, or we're going to cut your budget? And then there would be some yielding to these pressures. Well, the Federal Reserve doesn't go to the Congress for its budget. It doesn't say, could we please have some money? The Federal Reserve, here's what they could do, but they don't do. What they could do, of course, is just say, hey, we need $2 billion to operate the system. Turn on the printing presses, print up $2 billion. They don't do it that way, but they do it that way, but it's in an indirect, roundabout way. What they will do is this, is in conducting their monetary policies, the Federal Reserve purchases bonds, and then what they do is they hold those bonds and they collect interest on them. And then they use the interest from those bonds to pay their bills. And any extra interest that they get, and there's plenty, then what they do is they hand that over at the end of the year back to the Treasury and say, here, we wanted to basically kick this into the, to the budget. If you'll remember the term seigniorage, seigniorage is the profits of those who create money. That's how the Fed receives its seigniorage, is when it's, and we'll come back and talk about the details later, but when the Federal Reserve is increasing the money supply, it does that by buying Treasury bills, Treasury notes, Treasury bonds, but it buys those. And when it pays, then the dollars that the Fed is paying for the Treasury bills, notes, and bonds, those dollars enter the economy. But now the Federal Reserve is holding these bonds and it collects interest on them. And that interest is the seigniorage. It is the profits the Federal Reserve receives from issuing that money supply. Okay, and so anyway, this seigniorage I'm saying that the Federal Reserve has, it spends some of it to pay their bills, and then whatever's left over, it hands it over to the Treasury. And that then goes in with tax revenues. Here's what we find out. In a big study that's been done over many, many years and over many, many countries, what we find out is that there's this relationship between Fed independence, not Fed, we'll say central bank independence, and inflation. And that relationship looks like this. That is to say, there's an inverse relationship. The more independence the central bank of a nation has, and this was done, like I say, over decades of data and many, many different countries. And so what we have down here toward this end is the United States and Switzerland and Germany. There are other countries scattered around this, and up at the other end we have Spain and New Zealand. Canada someplace in the middle. And so what this is telling us is just exactly what we thought, and that is the more independent these central banks are, and there's an index number of independence that's assigned here, 1, 2, 3, 4, 5. But the more independent these central banks are, then the more they are able to combat inflationary forces. Okay? What we have periodically, and we'll finish this up, what we have periodically is an attack on this independence by members of Congress. Not all members, but a few members of Congress say, this is wrong for some reason or another, and then they'll go after that. And most recently, what we've had is somebody saying, this is wrong, we don't like the way the Federal Reserve handled itself over the last few years, we want to go in and audit the Federal Reserve, basically do some performance measurements, cut their budget, or make rules to limit what they can do, but there's been an attack on this independence recently. in my opinion, it would be a real mistake to limit that Fed independence. I think the Fed's done a good job over the years, and also during this economic crisis of 2007 through 2009, the Federal Reserve responded in a very effective way at avoiding any kind of a Great Depression or a major recession. We'll finish up with this next time and talk about monetary policy. So long.